If you don't already know, my name is Carl Dahm and I've been trading options for over 30 years now. Welcome to an in-depth analysis on performance and risk management. Today we'll dive into the 112 trading strategy and examine its performance during volatile market conditions. Using a real-world example and backtest software, we'll explore how significant losses can occur during a market crash and emphasize the crucial role of proactive hedging. Join us as we uncover key insights and strategies to help you navigate the market volatility and safeguard your investments. Okay, let's talk about the 112. I'm sure there's many variants to it, but let's talk about going into this, let's say February 12th, 2020. Price chart, nothing indicates here that there's any problems coming forward. Volatility is low, normal market. So let's put one on here with ES, options on futures. And like I said, there's probably different variants, but let's go with the 120 DTE, or closest to 120 days until expiration right here. And we'll back test it coming from this time forward. Let's see how the 112 performs. Typically, you've got your put debit spreads, right? Puts, calls, at around the 25 delta, and you go about 50 points wide. 5, 10, 15, 20, 25, 30, 35, 40, 45, 50. There's your debit spread. Then you want to finance this with your two short puts at around 5 delta. That's closest to 5 delta. Let's go with two short puts here to finance this thing. Look at it on the risk graph. You can see you've got your, I guess what they call the trap here. Right, got your trap going on, right, and you got your positive upper expiration line, so you have no upside risk, and things just expire, and you end up making money. Maybe the profit target here could be, let's just say $500, for example. Okay, I'm going to commit this trade. Call it a 112. And let's see how it performs. The stop out is when this is paid 1075. So when this, some people do this kind of stops, where if this doubles in price, so let's say this becomes around $21.50, this price right here, then it would be an exit. So if the price of this ever becomes $21.50, we know we've got to exit out and take our loss. Let's move forward here. Let's see if we hit profit or anything. So we're up $1 the next day. We're on Tuesday the 14th now. You know, we're up 20 bucks. Nothing to do. We're up $70 on the 17th of February. You know, the price of this is pretty much staying, it's up a little bit, because you're down here. So let's go to the next day, the February 19th of 2020. And you can see here, we're not looking to take this off at, you know, maybe it's only worth $1 or something like that. We take it off. We're still going into February 2020. Look, we're down a little bit. This is not at 2150, so we're not worried about exiting. Okay, we're at the 24th. Let's go to the 24th. Okay, so it's looking like here it's time to exit this, right? So let's exit this. Let's just cancel it out. And probably be left with the debit spread, right? You're still left with the debit spread. So you could potentially, if the market goes back up and you get whipsawed, you could lose 1,500 bucks. Or if it continues to go down, you could make, you know, almost 1,000. I'm just going to leave this on. Now, what do you do next? Well, you put on another one, right? I mean, that's what you do. Let's say closest, this is 4 days away. This is 7 days away. So I'll put on another one, a 112. We'll go to the 25 delta. Closest to 25 here. We'll go 1, 5, 10, 15, 20, 25, 30, 35, 40, 45, 50. And we'll go down to the 5 delta, sell 2 of those. They're both 8 away. Let's go with this one. could go either way, I guess. -2 to finance that thing. And we'll isolate the trade here. And we'll call it a 112 again. Okay. Okay, so we have this couple 112s. We got this one right here, 12 days in, and it's only a put debit spread. I'm not sure how you would manage that, whether you would leave it on and probably lose, or leave it on and make money. But I'll just leave it on. Say it's been paid for, I guess. And then we've got this one. We've got the new one we put on because it's another day. We put on another trade. What happens here? If this needs to go to around what 23.50 to hit a stop loss, let's go to the next day here. Watching that, it's at 15.50. This is coming down. Let's go to the next day. We come in, look at it the next day, and it's at 14.25. So we're still just hanging in there. Let's go to the next day. Okay, so this is stopped out. You're down $1,330. Let's go ahead and take this off. And maybe you're just left with those debit spreads. Got a couple debit spreads here. Let's see how those are looking. Okay, well, they're down, but they have a lot of potential. All right, so what do you do next? Well, you put on another one, right? I mean, what's going on here? Let's see what the VIX is. The VIX is trading at 30. Last was 32. I don't know of any rules as far as the people that trade the 112s. If the VIX is at a certain level, they don't trade it. I haven't seen any rules along those lines, so I'm assuming they put on another one, right? So let's go to the closest to 120 DTE. We got 113, 124. So this one's closest to 120. So let's go to the 25 delta. This is closer. So 1, 5, 10, 15, 20, 25, 30, 35, 40, 45, 50. There's your -1. Let's go finance this at the -5 delta here. Short 2. And we have another 112 on because we're trading 112s. And we'll call it a 112. And let's see what happens with that 112. Okay, so we got another 112 on here. Let's watch the price here. If it gets to $29, right, twice the amount of the price, we'll exit. So let's see what happens. Okay, the next day it's above $29, so we definitely need to exit that. So let's do that and see what we're left with here. Probably left with 3 put debit spreads, right? 116 days, 1/4. Let's look at each one individually. Okay, well that one's just barely breaking even, but we did take a loss on the short puts. This one's still down, and then of course we have this one here. So let's go ahead and run the report. Let's see how we're doing so far with these 112s, and we're just in February 28th. As you know, this is just the beginning of the crash. The market does crash much harder than this. Okay, let's go check our results. We've been trading for what, 2 weeks with the 112. Just go to the reports. I got my 112 report here. You can see I've got 3 trades and down almost $5,000. So I put on 3 trades. So what am my profit target? $1,500 maybe, $500 per, possibly, depending on how you trade it. But down $5,000 on the first 3 trades. I know that if you kept opening these things, you're going to get beat up pretty bad. So I just wanted to run through the risks, the possible risks. Also, you know what I can do here? I'm going to go back and I'm going to go through the original trade, this one here, and I'm going to just run it through. So I'm not going to close anything. I'm just going to show you. I'll just delete this. Let's just run it through from the beginning. Well, we know nothing happened for about until we got to maybe the 24th. everything was pretty normal until we got here. Let's see here. Start at the 20th. Everything's fairly normal here. Now we're going through the 21st. You know, normal. Market's down a little bit. Now look at this. The 24th comes along. You got this 112. I'm not sure what your profit target is. Maybe it's 500 bucks. Let's see what happens the next day. You can see here that it actually went down as much as $2,300. It's down $1,368. Let's go to the 26th, see what happened. Down around 1,200 bucks, but it also was down close to 2,100. And February 27th, 2020, you can see that it actually came down almost $5,000. It's down 3,400 at this time of day. Let's go to the 28th, see what that looks like. Okay, so if you were to hold a 112 through here, you're probably not going to hold it, right? But if you did, this is how dangerous these things can be. If you get caught putting one on at the wrong time and the market crashes, you know, this one's down $8,300. So let's say that the same thing occurred. You know, I put one on. What do I have here? Let's say I put this one on right here on the 27th. Let's see what that looks like. So delete this, you know, without closing it out. So here is a brand new trade, right? Let's see, go back. Yeah. So here's a new trade you put on the 27th. You think, oh, the volatility is super high. It's going to revert. It's a good time to put it on maybe. And let's see what happens here. So the next day you're down $1,700. Then March 2nd, you're down 800. This is trading at 8:30 a.m. on Pacific time. 755, March 4th, 580. You're still not in the bear trap, right? You're still above, so you feel like maybe you're safe, right? Down 1,000 there. Okay, you're still not into the, you know, you're still here where you might feel comfortable because you know, at this price, technically you should be fine, right? Because you have this headroom here, but look at, you're down $3,500. So, you know, volatility plays a major factor in the trades when there's a crash. So you have to pay attention to not just, you know, the 112 structure, but what is the negative vega, because the volatility can expand rapidly in a crash, and you're here down 3,500 bucks. And what can you do? You know, hold on. And the market keeps going down. I mean, what does it look like on the 12th? I mean, you don't want anything to do with this thing, right? Now you're down 15. I mean, it's worst case scenario and all that kind of stuff, but I just want to show, hey, these 112s can be dangerous if a crash occurs. So you got to be careful and cognizant about that. Of course, keep some hedges on, but you need to back test this thing to make sure the hedges that you have on will actually protect this thing. So when you put the trade plan, when you're working your trade plan, be sure that you know, have some safeguards, and not only I just don't recommend reactively hedging. I recommend proactively hedging. Already be hedged before this big crash occurs. And if you don't think there's going to be another crash, then this is a great trade. But me personally, knowing that eventually the market's going to crash at some point, I don't feel comfortable with something like this. In conclusion, our backtest revealed a substantial loss of nearly $5,000 from 3 trades consecutive by February 28th, 2020, and over minus $15,000 from a single trade if held until mid-March of 2020, underscoring the inherent risks of trading 112s during turbulent market periods. This analysis highlights the importance of potential losses that can occur with the 112. My goal was to bring to light the importance of understanding and implementing a trade plan that takes into account the potential risk of the 112. I hope this video has provided valuable insights into managing performance and risk effectively. Stay tuned for more expert strategies and tips to help you succeed in your trading. And thanks for watching, and don't forget to subscribe.